If you host a short-term rental in Brazil, you already know the federal framework. What most hosts miss is that the state your property sits in adds its own layer of obligations on top of everything else, and that layer is changing faster than most people realize. Brazil does not have a single short-term rental law. Several layers of legislation work together: the federal constitution, the tenancy law, the consumer protection code, and then municipal regulations and zoning rules that define where short-term accommodations may legally operate. States sit in the middle of that stack, and their role is growing. Brazilian states are responsible for their share of the new IBS tax being introduced under the National Tax Reform. The IBS will replace ICMS, the state-level VAT, as part of a transition running from 2026 through 2033. During this period, both old and new tax obligations will run simultaneously, meaning hosts who operate across state lines or at scale will need to track two parallel systems at once. Under the new legislation, individuals who rent out more than 3 properties will be classified as IBS and CBS taxpayers, triggering a completely different tax structure with an estimated 10 to 15% increase in overall tax burden. Most hosts crossing that threshold have no idea their classification has changed until they face an audit. Brazil now operates a nationwide software-based fiscal system requiring electronic fiscal documents for transactions, and the tax authorities have made clear that invoice errors are no longer just technical mistakes, they are treated as tax risks. The state knows what you earned, your filings need to match. Get your property report on lodge compliance. Know your state-level obligations, your tax classification, and what the reform means for your specific situation before the transition catches you off guard.